Hello, everyone. I'm super excited to be here to have these amazing OGs, Kevin Lin and TN, as our speakers today. So we are going to talk about all things fundraising, and we're going to talk about a lot of, I think, specific experiences that both of them have had in their various ventures, and try to also make it as actionable as possible for everyone. So let me just kind of tee up these speakers real quick. So first we have Kevin Lin, who co-founded Twitch, which we are also live streaming on. And so Twitch actually sold to Amazon back in 2014 for $1 billion, and today it has more than 140 million monthly active users. More recently, Kevin's also raised 24 million a Series A for his Web3 gaming studio, Metatheory, which I will let him talk more about in a second. And then for Tien, Tien's also quite OG. He was a former founding member and head of business at Kyber. And with his current DeFi project, Pendle, he's had quite the amazing comeback story where their token price has more than 20x in the depths of the bear market from January through July this year. And yesterday was actually the anniversary of Pendle's V2, and they've now hit more than $300 million in trading volume. So with that, I will throw it over to Kevin. If you could quickly just give your intro and tell us a bit more about Metatheory.
Sure. Yeah. Hi, everybody. Thanks, Luke. Happy to be here. Like Luke said previously, co-founder and COO of Twitch. Took it from 6 people to over 2,000 people after Amazon. We got bought by Amazon in 2014, experienced the corporate mothership and the pains and the goods that come with it. Eventually left in 2020 due to COVID, moved to Taiwan. And as a result of being there and it being open, met a lot of folks from crypto, sort of revitalized my interest in the space. And then eventually launched a game company called Metatheory. We launched first an NFT project in December 2021 called Duskbreakers with a play to mint. I think we were the first to do a play to mint. We actually built a browser game, like a semi-decent. I mean, it was not a long build. It was a playable browser game, a looter shooter game. And then we've since been iterating on that as a PC game to launch a full NFT integrated game. We're actually doing a playtest today. Just a small holder playtest for our combat system and our enemy system and progression systems, just to test it out early. Continue to build that. We raised money in sort of first quarter 2022 from Andreessen and Pantera and several angels, 24 million. And then I also have a fund called Lifelike Capital, where we invest in the attention economy space. So games, social platforms, digital media platforms. Yeah, that's me in a nutshell.
Awesome. Thank you so much, Kevin. And Tien, could you please tell everyone a bit more about yourself?
Mute.
Oh, Tien, you're on mute.
Sorry about that. Yeah, thanks for having me. So I'm TN. I started out my career in crypto professionally back in 2017 as one of the founding team members of Kyber. So we were one of the first DEXs. So I've had the privilege of sitting in the front row seat to see how the ecosystem developed. And then following that, I stayed on at Kyber until early 2019 and decided to leave the team to explore other opportunities in the crypto space and outside of crypto. So I aggregated a group of people who are now co-founders of Pendle to experiment with some ideas. So we've actually had a string of relatively unsuccessful business ventures between 2019 and 2020, but decided to be more serious about building Pendle when we saw an opportunity to construct a fixed income product for the DeFi ecosystem. I mean, back then it was during DeFi summer and we were all farming shitcoins. So this was when Yam and all the sushi, all the food tokens came out and they were offering 10, 20,000% APYs. So we were farming those sweet APYs, but at the same time, it was also a realization for us that the yields were not sustainable. And one way or another, we wanted to find a way to lock in the yield, but there was no good solution out there. So that became a motivation for us to construct Pendle. And then fast forward 3 years later, we're seeing some form of market adoption, and we think that we're heading in the right trajectory. So more to come in the next 12 months or so. But in all, pretty glad to have gone through this year.
Awesome. Thank you, TN. All right, so let's get right into it. So I think just to lay out the landscape a little bit, first, how do you guys think about the different types of funding available to builders in crypto? Why don't we kick it off with Kevin, if you could maybe talk a bit about kind of the VC landscape, accelerators, as well as NFT mints.
Yeah, I mean, NFT mints was, I think, well, let me work the other way. Accelerators, there's a lot of them. Press start. There's 500, there's Techstars, there's YC, of course. There's lots of great accelerators, and they're not so much, many of these that I mentioned are not so much focused on the Web3 side, although they may have a partner or two that do. It's just general survivability of a company. How do you build a team? How do you build good culture? How do you start to get customers? How do you talk to customers? How do you process customer feedback into product and feature ideas? And of course, how do you raise money? I think accelerators are great, depending on your business more. YC is an example. I mean, their partner base is truly amazing. They can cover pretty much any subject, any sector. But it's particularly beneficial for enterprise and B2B products because they have so many, over 4,000 companies in the network. And so it really helps you kickstart your customer base, and founders in the YC network, because it's such a tight community, really do want to help each other out. And so there's benefits to that from an early stage. The trade-off is you're taking often less money for more equity. So the average valuation for an accelerator is less than 2 million, and you're typically getting less than, let's say, 200K, depending on which accelerator and where in the world you are. Could be as low as 50K or less. There are some accelerators out there that there's no money, right? It's just mentorship and program and network. And so that's what you're really trading off there is for, if you're truly early stage and you need access to a network, that's the rough high level trade-off. Then you're trading mentorship for higher equity take in the early days. For them, it's a good deal, but it's a pretty good overall deal structure. I think in the space that YC really set as a precedent through the SAFE. The SAFE is it's a very fair deal between founders and investors. Maybe a little bit more founder friendly than investor friendly, but it's fast and it's cheap, and it saves you the $10,000 to $20,000 of legal fees that otherwise you may need to do if you find an investor and want to make sure you protect yourself. So that's huge savings, right, when you're early stage. On the just general equity funding side, I mean, it has been suppressed lately due to macro conditions, of course, on the crypto side, on the blockchain investment side, but it feels like it's starting to come back. There's always a bubble. There's always some sort of bubble. Web3 was a huge bubble last few years, and then obviously that burst. AI is now the bubble. Games for there's not always just one bubble. There's always these intersecting bubbles. Gaming was a big bubble for a while that was further exacerbated by Web3. But right now it seems like valuations are sort of going back to normal, as they would say in the industry, which is it's sensible. It feels worse for founders, as in, you might have friends that raised at a $40 million valuation pre-product last year. That's not going to happen anymore. And I think that's okay. I'd never say never, right? The macro trend on the funding side, on the VC side, is a lot of these VCs raised in 2020, 2021. And venture funds, I'm also running a venture fund. So I've seen both sides of this. As a founder, raising multiple times, and also as now an angel investor, but now a venture capitalist. You have about 5 years to deploy. And so if you raised in 2020, 2024, you're starting to hit your tail end of your investment cycle, your fund cycle. And so I think there's going to be decently quick deployment. Again, probably more sensible on the valuation side, although they may come up a little bit as a result of high supply of cash that needs to find equity. So I think, sometime in 2024, maybe around the end of the first half, I think you'll start to see some acceleration there. But I think what's great about what's going on in Web3 is there's been maturity, right? Through all these cycles over the last 12 years, 13 years, you're starting to find like there's platforms that are maturing, there's business models that are maturing, sensibilities. Doesn't mean we're not in for another silly hype cycle. But I think within the next cycle or cycle and a half, let's say, I think it will settle down to where products are coming that are more mainstream. Equity investment is interesting because if you handle it right and you do grow your business well, there are options to buy back, right? You can always buy out early investors back through secondary. You can sell secondary in the future to take some cash off the table as you build when markets are good. In down markets, it's hard to sell secondary, of course, but oftentimes you can do that. So you can take a little bit of stress of finance off of your shoulders as you build your product successfully. NFTs is a good funding mechanism in the sense that it doesn't take equity away from you, but it is largely undoable. And the reality of startups is most startups fail. And so if you're raising NFTs and your users are buying them, that's great because it's effectively a crowdfunding mechanism. The problem associated with NFTs historically is that they're associated with very fast profit gains, which is not tenable, obviously, as we've seen, sadly, as the market fell out. And so you have to be careful about the promise you offer your users. You have to be clear about what it is that you're actually building, because it's undoable. And there's this pressure because there's all of these holders that have helped you out to build for them. But if a project's just really going nowhere, versus equity and venture, where if you're raising from angels or venture capital, if you have to shut down, that's really sad. But they're professionals, so to speak. They're taking a calculated risk, whereas the NFT market for a while was more. It's not that they weren't educated in a way, right? They kind of know what they're getting into, but they're still, in a sense, not able to take a big hit, right? And so it is a psychological burden that you have to live with if you do that. It does feel different than taking equity investment.
Thank you so much for that amazing overview, Kevin. And now over to Tien. Can you talk a bit more about, I guess, the fungible token side of things, right? Kind of all fundraising related to fungible tokens and even foundation grants. And if I remember correctly, I think you actually went through Alliance twice, once with Kyber and once with Pendle as well.
Yeah, so I think generally in regards to fundraising through the issuance of tokens, there are a couple of things, but more generally, through an IDO venue is probably something that we see a lot more common. And then so projects that generally get a lot of attentions, they were product of, say, Binance Launchpad, Binance Launch Pool. So those are venues that a lot of token issuers would want to strive for because of the publicity and the distribution. And then, of course, there are also other avenues to issue tokens. For example, doing it through fair launch. This was something a bit more common back in the days, but not quite these days, because in order to bootstrap interest from the community, it was not uncommon for a protocol operator to allocate a portion of incentives or upcoming incentives to liquidity contributors, and then from there on, the tokens would launch in accordance and distributed in accordance to the kind of effort and the support that they've offered to the protocol growth in the earlier days. And then depending on the spread, there are probably different ways to game the valuation of the tokens. But this is becoming a lot less common. But and then on the far end of the spectrum, you have the typical raises. So, like, for example, like Pendle, we raise a private round, and then followed by a public round through liquidity bootstrapping event. So the private round, I think, is somewhat similar to SAFE, except that there are some modification to the raise. So instead of offering equity, a SEF is basically offering like the prospects of tokens. Now, during that phase, it's quite important to think about the different types of the breakdown of the total supply of the token. So, for example, you intend to mint maybe 1 billion tokens, 20% of that goes to the team. Typically, it's in the range of 20 to 25%. And then a portion of that to be allocated for liquidity incentive. Again, this is probably more relevant to DeFi protocols because liquidity is actually a very important aspect of the protocol growth. So usually the range of 40 to 60% of the entire token supply to be allocated to liquidity incentive over a period of maybe 4-6 years, sometimes indefinitely. And then the change would subject to a governance proposal. And then the rest of it to be distributed to the ecosystem, the team, the investors and potentially advisors. So from there on, I think because of the token issuance, some other considerations for a token project when it comes to raises would be like market making from very early days. And then very importantly, also the token utility. So I think the token utility, as much as possible, it has to be tied to the protocol, the nature of the protocol. If a token has no utility and does not contribute to the overall well-being of the protocol, chances are when it gets issued, it would be dumped and the selling pressure would be very, very high. And once the token price tanks, it becomes a very difficult thing for a protocol operator to try to lift the token price from like safe bottom all the way up. So we've been through that process. It's incredibly difficult because when the price is tanking, everyone has no confidence and everybody just shifts attention away to some other protocols. And then at that point, you have to figure out ways to regain it attention and also build up the confidence. So I think I guess like looking back, what we could have done differently was to assess the validity of the token, because when we launched Pendle V1, the token didn't have very meaningful utility aside from the prospect of governance proposal. So with V2, we incorporated VE Pendle, and then we built a product that had we revised the product and incorporated additional utilities for the token. So beyond just like voting, there's also boosting of incentives and potentially claiming the yield that the protocol collects. And then I think from there on, considering the different venues for the token to be listed was something that we were pretty strategic about. Because tokens, once issued, they can be traded on decentralized exchanges. And typically, I think in the absence of good liquidity, the volatility of the token price can swing quite widely. And for good and bad reasons, it's usually very hard to control. So like, for example, if the community loses faith in the project, they can dump. And then if there isn't sufficient liquidity in the token pool, it's just gonna, everybody is just going to fight to not be the last person standing and don't want to be the exit liquidity. So in those kind of situations, it's usually too late. But even before then, considering the market making and also the venues to list the tokens, those are I'd say like pretty important considerations for a project from a relatively early days. But yeah, it's a good consideration, but doesn't mean the execution has to be immediate. So yeah, that's kind of my experience with the token side of things.
Yep. Super helpful. Thank you, Tian. I guess just to follow up on that a little bit. So, you guys have have kind of done the gamut, right? In terms of token fundraising, you've done IDO, you've done a private sale, you've done OTC sales. Could you maybe talk through with us a little bit, uh, kind of why you guys decided to do each of those at the
Hmm.
specific point in time of Pendle?
Sure. So in the early days, we had no track record. We needed support, and we needed a positive brand association because, like, we were just, basically a few of us in a founding team with some history of working with other companies, but we didn't have a track record to show as a group that has done like our build products. So we needed the positive association. And in the earlier days, we tapped, we reach out to some friends in our circle to raise some money, primarily to give ourselves the runway to build and hire people from the idea to a prototype. And then from there on, we did another small raise to to do another raise for a longer runway. And then 2 months after, and this was in April 2021, we decided to go for a liquidity bootstrapping event on Balancer. So just for context, right? When I think one of the more interesting use cases for Balancer back in 2021 was for all the fundraisers. Basically, instead of selling tokens through IDO platforms and launch pads, the like for us as project teams, what we could do was to set up a liquidity pool. So deposit the protocol token along with a base asset, for example, stable coin like USDC or USDT or Ether. So we did Pendle against Ether, set up a pool that has a duration of maybe 6 hours. And during that 6 hours, users could like anyone from the community could trade against the pool. So the ultimate aim for the pool was to fundraise, not quite in the conventional sense, but yeah, basically trade. And because of the demand, with more people selling ETH to buy Pendle, the price of Pendle would go up. And then 6 hours later, we shut the pool and collected all the proceeds. So there will always be some portions of Pendle left in the pool. But ultimately, I think the Pendle ratio would drop and then the Ether portion would go up. And whatever change in the Ether quantum, that's the raise proceeds. So we did that because it was a relatively easy setup for us, and we were comfortable in our marketing to the community because we were going after a different kind of narrative from most other protocols back in 2021. So we also thought that like just because with liquidity bootstrapping event, not that many projects have gone through it, but the ones that have done it through Balancer, they have achieved reasonably good result. And we thought going through that route versus the launchpad could give us better amount, bigger raise amount. And then secondly, the setup was just quicker. I think the other thing was relatively to the other launchpads, Balancer pool was just anytime you want to do it. Compared to in the case of Launchpad, you had to line up and then you have to do pitches, and then maybe there's like a 2 to 3 months waiting time.
Yep. On that note, Tian, could you maybe give kind of the non-DeFi degens a quick like 30-second ELI5 on IDO, Launchpads, and Balancer?
Yes. IDO and Launchpad are actually pretty similar. So IDO, it stands for Initial DEX Offering. It's an equivalent of exchange offering, like an IEO, except that it happens on a decentralized exchange. And I think the more popular platform for IDOs would be the AMMs. So Trader Joe, Camelot has done a few of that this year. And then back in the day, Sushi was also a very popular venue. So typically, the protocol operators like the AMMs would offer some marketing support. And that's one of the main draws for IDOs on these respective venues. Launchpad is a venue that is dedicated for token issuance. So Binance Launchpad, Impossible started out that way. And then there's also CoinList. So I think these are some of the more popular launchpads, really just for the first time token issuance. And then liquidity bootstrapping event is just like what I've described. That's one of the earlier use cases of Balancer, where instead of selling tokens, you're setting up a liquidity pool for the trading of tokens over a duration of a couple of hours to maybe 48 hours, 72 hours.
Got it. Cool. Thanks so much for that. I'm going to throw things over to Kevin for a bit. Kevin, so for Metatheory, what kind of funding options did you guys consider? And then did you decide to do versus did not decide to do?
Yeah, so we started with the NFT, like I mentioned, sold a typical PFP 10,000 set with the game, and then we did another smaller mint with a secondary follow-up. We considered a token, but we just so some of what TN said earlier, it's easy to say utility is coming with game, but as we really thought about it, we were like, well, if we want to build a fast game, it won't have utility. It's going to take time to build a game that has a robust enough, quote unquote economy, as in economy in this sense, very simply defined as jobs, essentially. Are there things that you can do in a game that create value based on time spent or skill, and skill that increases over time and reduces the amount of time required to do things? That started how we started thinking about it, and so we felt increasingly uncomfortable just to launch a token for the sake of launching. We wanted to get to a system that we could see people participating in and start to understand what it is that they wanted. Very similar to how the real world works, right? If you have a small village community, people play different roles, people give each other stuff, and eventually as it gets bigger, you need some sort of currency to keep track of all the favors that are being exchanged, essentially. So maybe we went a little too far in our thinking, too deep into our brains, but it felt very thin. We were very anxious about it. And so we decided to defer that and decided to go equity route. A bunch of our friends on Angels, as Angels, wanted to invest super early. So basically, as soon as we launched the NFT project, we re-engaged with a bunch of our angel friends and did a small angel round in January. And then in March at GDC, we talked to a bunch of VCs and a lot of friends in the space. And Andrew and John from Andreessen were nice enough to make a great offer for us to take an equity investment. And there's fundamental trust there. I trust those guys. I know them for a while. Met Chris Dixon, the crypto team as well, and just felt like if we were going to build something big in the space and take the time to build something, because games take forever, we would need investors like that could really support us. We met Paul and his team from Pantera, and just lovely people, amazing people, and really wanted to work with them as well, and many others that came in to help us in various ways. And so we were fortunate in that, given our network and the folks we've met in our lives, we could round out a good team that could help us with economy design thinking, all the blockchain crypto thinking side, marketing, creators that could give us real feedback on their opinions of where Web3 is going, so that we can sort of think in our way of how do you bridge this big chasm between traditional gamers and the fear of Web3, largely due to the unfortunate activity that was all going on as we all went over degen. Yeah, so that's how we thought about it. I think we could have launched a token. A bunch of our friends were doing it. It felt exciting to do it, as we started planning towards it, but we just felt very nervous about it. We felt like we needed to get the product out first, and so that's why we decided to go the equity route. But that's us, plenty of folks do it as a true funding, as a very, if you do it the right way and launch a token or NFTs, long as you're very clear. I look at meme coin as like a really good new example of like, look, we have no idea what we're doing, but if you want to come along for the ride, here it is. Join our community, buy our currency, join our community, now be a part of it and see where it goes. And that's correct, right? That is actually the spirit of Web3. And I think the industry somewhat over rotated into utility. It was sort of a false battle cry, in a way. And I think actually in equity, when you invest in a startup, like the battle cry is the founders and the idea that they have, and the theoretically large market that they're building into. Not much else as an angel investor, and so it's not that dissimilar, right? So as long as you trust the builders, the founders of any project, any funding mechanism should, in theory, work. The problem is you're dealing with this macro of what's going on in Web3 of like how people abuse each other, so to speak, in any token system. So that's the danger you face with that way.
Awesome. Thank you, Kevin. So Tian, you've raised from, I think, both kind of the crypto VC side, kind of angels, as well as kind of crypto whales and crypto hedge funds as well. Can you talk a bit about how these groups kind of behave differently as investors?
Yeah, so I think like in regards to angels and whales, generally check sizes vary, but in terms of the value add, I'd say they all contribute quite differently to the product, and also maybe a different part of the product lifecycle. Typically, we start off, at least in my experience, I started off with more of like just approaching angels and whales in my circle and get them to be involved in the project relatively early on, because a lot of them had been involved in the space and have built product prior. So their experience as founders was very valuable for me to think about the structuring and also the subsequent design of the protocol. And yeah, angels are mostly just friends. And then in regards to the VCs and hedge funds, I think the line isn't exactly the clearest in crypto, because a lot of VCs are actually hedge funds, but because and being hedge fund has its benefit because it allows for a more flexible deployment of capital, right? Like sometimes, like right now, for example, market is relatively bearish, but shows some promising signs of traction. As a capital deployer, I think in the prior to this event, the more sensible thing to do was probably to scoop up some cheap tokens in the secondary market through decentralized exchanges or centralized exchanges. And then when the time changes, then can probably go back into early stage rounds or late stage rounds, and be more involved in the product. So I think just from observation, I think a lot of funds are actually in crypto or Web3 at least structured as hedge funds, but with very, very flexible mandate to deploy into very, like primary and secondary markets. I think also beyond that, something else that hedge funds can do but VCs can't really do is to become a liquidity provider. Again, as a investor in a Web3 DeFi project, one of the biggest value adds is liquidity provision. So it is rather common for a protocol to raise funds with some form of guarantee from the investor to contribute liquidity. So for example, every dollar invested, the investor has to contribute maybe $10, $20 worth of TVL to the protocol. Because that I think for DeFi protocol to bootstrap and build confidence, having liquidity on day one is it can change your perspective. it gives the impression that there's actually some utilization of the protocol. And then as a retail user, if I see a protocol already having $10 million, $20 million on day one, I would probably feel more confident in deploying my own capital into the pool and then earn some APY. So the value adds are pretty different. And I think the hedge fund structure is generally quite preferred in the space.
Yeah, absolutely. So next question for both of you guys. What do you think are the most important things to consider when fundraising?
Go ahead, Dan.
I think from my side, from my experience, I think it's one of the more important things is to be ready to adjust the terms readily, because in the beginning there could be an assumption from the fundraiser, like the project, but like I could have an expectation of my valuation to be like, say, 10 million, $20 million. But after going through a round of conversations with various different individuals and funds, that perception could change, and sometimes for good reasons. Maybe because the market is heating up and the valuation should be higher, and then we don't necessarily have to settle with the terms that we set for ourselves initially. Sometimes it should go lower because the market is relatively bearish. The sentiment is not quite there to support the valuation that we're all aiming for. And then we just have to be flexible with that. Because I think when it comes to raise, especially in early days, most of the time, the protocols that are looking to, the projects or companies that are looking to raise, the runway is relatively limited. Now, I would typically optimize for cash. So even if at lower valuation, I'd be more than willing to take if the value add from the counterpart is substantial.
Cool. Thank you.
Yeah, I mean, what can I add to that? I think that's right. I think, investors matter. I think when we were growing up in 2008, 2006 too, and plus in San Francisco, at the time, because we went into this recession, a lot of the mantra of founders was like, it's just money. Don't worry about the investors. But that is bad advice. The investors really do matter. They're your partners. Good investors will help you and not do damage. I've seen companies get torn apart by boards. We kind of just saw this in a big way with one of the most important companies in the world. So you have to be careful. And these days, especially in a down market, in a slower market, I should say, it's going to take multiple meetings. And so take the time to meet with investors, ask them questions. I find a lot of particularly young founders won't ask questions of the investors. They just wait for the investors to ask them questions. And then once the questions stop, they're like, oh, I guess the meeting's over. We're good. You should really take the time to get to know them, how they think, what they care about, what their expectations are. So as an example, on the earlier point of what's the funding situation in Web3 right now, that yes, there's money coming down the pipe. Some of these investors still want to see tokens that are essentially very similar to the last hype cycle. So they expect you to pump. That's just the reality. That's what they sold their investors, their LPs. That's what they told them they would do. And so that's the expectation on the return profile of the investments that they make. And so be careful, right? Again, you have to be very clear on what their expectations are as well. I think there was another question in the doc. Maybe this is for later, just about sort of structuring a strategy when you raise on the equity side. Obviously, very different from what Tian's been saying on the token side. These are very extremely different strategies. So we can talk about that later. But I'd say that's one thing, right? Get to know the investors, ask about them, ask for reference checks, talk to other founders that they've invested in. That's really important as well. On the flip side, yeah, it's the investment strategy is really in a down market especially, is about making a market for yourself on the equity side. That means you get really super organized. You test your pitch with your friends and peers and mentors as many times as possible. Really hone it. Get the introductions to the investors, whether angels or VCs, and then line them up really quickly. What you don't want is like a slow, dragged out process where you talk to one or two investors a week over the course of months. You're going to screw yourself that way. You need to talk to everybody within 2, maybe 3 weeks as fast as possible, because the reality is these investors all talk to each other. They're all going to ask around. The small community, they're going to, hey, what do you think of this? What do you think of that company? And they'll share. And then if they like you, they'll maybe come in together. They may, there is the reality of the human investing side versus like a token launch where you just kind of, it's nice and transparent. It's sort of, what you're getting into, but you don't have to like negotiate necessarily on a user by user basis. In the equity side, you are negotiating, and so they do band together sometimes, and so you have to be fast, and express the excitement, do your homework, do your math, show why your idea is big. Again, that's best stress tested through feedback, and then create this fast market for yourself where everyone gets excited, everyone's talking about you, and then you have to do some selling at that point. That's when you start to go back to your favorite investors that you met and say, hey, we really like you the most. It's been great getting to know you. Now that we're raising, we really want to pitch you. And then, but if you're willing to come in, we'll give you a special deal, right? Versus the other way of this fast market creation is just wait for the market to come back to you and say, here's a price. Try to get a term sheet, fish for term sheets as fast as possible. The other alternative is you go and say, hey, like we like you the most. We'll give you a 20 million, $10 million, whatever valuation if you come in by tomorrow.
Awesome. Yeah. Thank you for all those tactical tips. And Kevin, you definitely touched on some of the other questions I was going to ask.
Yeah,
so thank you for that. No, that's perfect. Especially because, we are running into the later end of this session. So I guess somewhat related to that, for the both of you guys, and I think we touched on this a little bit, but I want to double click is how did you guys decide on how much to actually raise for kind of, for the round that you were raising at that time? Yeah, maybe we can start with Tian.
I think for us, it was largely benchmarking because there were no comparable products, but we were just selling an idea. So for us, we were designing the AMM for a specific type of token that wasn't around. So it was an entirely new sector, but we benchmark against the prospects of other AMMs like Uniswap and Balancer and Curve, and then compare that to the earlier days and where they are. I think, beyond that, it was also looking into the amount of money that you need, and then just from there on, project like because typically I think one of the important things for some DeFi protocols is to especially the protocols that are building in a market where the product might not necessarily serve a need yet. I think this goes back to my experience over at Kyber. We were anticipating that the DEX wouldn't pick up any adoption for the next 3 to 4 years. So based on our existing expenditure, we have to consider the burn for the next 4 to 5 years. And true enough, we launched in 2017, but the market only started recognizing the utility of a DEX in 2020 during DeFi summer. So in the same way, when we were raising for Pendle, because the market wasn't ready for our product type, and we were aware of that, we did a bigger raise in a bull market to account for about 3-4 years of runway.
Awesome. Thanks for that. Kevin, any thoughts here?
Yeah, I'd say I've had very different experiences raising. I think when I raised for Twitch, it was very, very budget oriented. We knew how much we needed to survive and get to, basically 12 months out, 24 months out. generally the way to think about a raise is you want to try to get to 18 to 24 months at minimum of survivability. Because by the time you get to 12 months, you need to start raising again. And if you don't have strength and you don't have growth of some sort, whether that's users or revenue, it becomes harder to raise, and VCs get more, the power swings in their favor when you are closer and closer to death, and they know they can negotiate more strongly if you don't have the growth story. So that's like the one rough way to sort of multiply what it is that you need. Let's say 24 to 36 months of runway is ideal if you can get there on a fundraise. I think for Twitch, it was very methodical. We had budget, we knew our costs, we knew our revenue, we knew how many people we needed to build the team out to hit our goals. With Metatheory, frankly, the market was so insane last year, and so we sort of just went out and we tried to raise 16. We felt like 16 would get us to 4 years of runway for a game, and we thought we could build the game really efficiently because we were building it out in Asia rather than in America. So it's just 4 to 5x cost efficiency. But then we ended up raising 24. There's just more interest in the market. It was just highly unusual. I'll tell you, and I think the valuation we got for Metatheory for first round was higher than our Series C valuation for Twitch, when we had 90 minutes a day, probably 10 million people coming to the site every day. We were profitable, and we were the fastest growing website in the world for, I think, a year and a half at that point. And the valuation then in 2013, 1 year before acquisition, was lower than our valuation for Metatheory last year, when we had just launched an NFT project and a little web game. So it's all market. You can't predict how the markets are going to be. You shouldn't try. But if you feel something good is happening that's in favor for you as a founder, you should chase it as fast as possible, right? But in terms of getting enough money, I'd say do your math, figure out how many people you think you need, what other costs you might have. That includes any compute power, any servers you might need to buy, any special software you might need to buy, cost of marketing, which you should generally assume to be 10 to 20% of your overall costs, depending on what industry you're in, and then multiply that out by, let's say 36 months would be the ideal amount. 24 months would be the inside amount.
Awesome. Thank you. So very last question, and then we will move to the much anticipated audience Q&A. So for both of you guys, kind of, maybe putting on a bit your angel/VC investor hats on, what are the biggest mistakes you've seen founders make when fundraising?
I guess, like, for me, I would echo what Kevin said earlier, not doing enough due diligence on the investor. I think in crypto there are actually quite a lot of bad players, because for crypto, raising money in token is still a very common practice. And because token becomes liquid relatively soon. So the moment you issue the token, it can already be traded on decentralized exchange, maybe 2 months after your initial raise. So it is not uncommon, maybe less so these days, but maybe a year, like during the bull market, there were investors, especially in Asia, that would invest, and then 2 months later, when the tokens launch, just dump on everyone else. That is not a good look that a project should have to take on. And I think this is in part like just due diligence, right? So ultimately, like as a founder looking to raise money, you want to know like what you're good at and what you're not so good at, and based on your assessment of your strengths and weaknesses, figure out types of investors that you want to work with. So again, like going back to the DeFi, I think like there's always merit in trying to get an investor who can provide liquidity to the protocol from day one. But that has to come with some sort of arrangements. So aside from just providing token, maybe enforcing a longer vesting schedule, or discounts of sorts, just to align the interests of the investor.
Awesome. Kevin, anything to add?
Yeah, I think that's it. And then what I mentioned earlier, just taking just being too slow, right? And then yeah, sorry, I was writing answers to this gaming one. A lot of it's relevant to this as well, broadly. Yeah, yeah. A lot of founders. This is not y'all, because you're part of a program that is going to train you out of these things. But so many founders out there put together a really simple deck, and they just rely on the trend and hope that they find some dud of an investor to kick it off and then snowball from there. That's not going to happen in this market anymore. So you really do have to follow up. You do have to do your homework. You have to have a good thesis. You have to do your budgeting. You have to be able to convincingly say why your idea is good and why it's going to be huge. And you have to have a clear definition of who your target audience is. A lot of people don't even do these basics. They just come with this idea, and I guess the more meme way of saying this is don't have a solution looking for a problem. Like, a lot of founders are like, oh yeah, this is obvious. People obviously want this because I want this. That is not only a mistake in a pitch, that is also a massive mistake in the development process of your product. Yeah, take a look at it. The question was more specifically around gaming. What are sort of do's and don'ts of fundraising for gaming, but it's a little bit different. Gaming is a little bit different build process.
Yep, absolutely. Cool. All right. So thank you both for all those amazing insights. We're going to move to the audience Q&A. And so kick it off, I think Vincent Gameland actually had a great first question that Kevin already gave a very detailed answer on in the Q&A function. But I wanted to just give TN a chance to share his thoughts on that as well. And I think before that, maybe Vincent, do you want to maybe just ask your question live for everyone listening?
Sure. So can you hear me?
Yes.
Okay. Actually, this question is very important for everyone. If we don't have any VC resource or some capital, we want to have some connection with them. So we don't have friends, we don't have reference. So what should we do at this time? And the money is very important for our team, for the other team, to support them, to get some money to support them in the next few 6 months or 1 year. So how do we try to solve this problem?
Yeah. So in the absence of any kind of VC connection, I think the best way to get financing is to go after foundation grants. So just for example, right now, depending on the trend, maybe it makes sense for you to consider building on top of Arbitrum. So Arbitrum and Mental, they are offering grants from the scale of 50 to 100K, no equity, no nothing. It's literally just free money to cultivate their ecosystem. So if you're really desperate, they are, I mean, like, even if you're not desperate, I think those are good resources to tap into, because even until today, when we launch on a new chain, we would always request for some grant money so that we could utilize it for marketing or for some other administrative purposes. When you launch on a new chain, there could be some cost. You want to go through audit. But that is, I think, like, part of the package. So yeah, in the absence of VC resource, I think that is a very viable option.
Cool. Thank you, Tian. Next up is, I think, another question that I'd like you to start answering first. So this question is from Nine CryptoMind on tokenomics. Nine, do you want to just ask your question live?
Oh, hey guys, can you hear me?
Yes.
All right, perfect. Thank you for having me. So, like, I think this goes to TN, but also to Kevin as well. So, just wondering how one should go about tokenomics design. You mentioning that you need to have adequate allocations for each category, specifically for protocol emissions and also community contributions, and for future fundraising rounds as well. Are there any tools or frameworks would you recommend to model this?
No cookie cutter approach here. I think we were just looking at the types of models that we want to follow. So one of the more, at least like in back in the days, one of the more popular templates that a lot of projects refer to was synthetics, because they pioneered the perpetual emission, which means that the tokens were going to continue to be emitted for liquidity incentive perpetually. Of course, that's changed now because they defer to the community to vote for the change. But that was how they started. So I think the breakdown for the token allocations for each of the different categories, like for example, to team, to investors, to like public raises, those are relatively standard. If you look across the protocols that have gone through that process, the likes of Balancer and I think even Lido, you could find pretty meaningful allocation breakdown for each of them, and then from there on, just decide what you want for your protocol.
Awesome. Kevin, any thoughts on this one?
No, I'm not as fresh on the current state of affairs on this stuff, so defer to TN.
No worries. All right, I'll do one last question, and then we're gonna move to the one-on-one breakout rooms in Gather Around. So last question is going to be from Chris on whether Twitter is necessary for fundraising. So, yep, Chris, yeah, please go ahead and ask your question.
Hi, thanks for having me today. Yep, my question is Twitter or X essential for fundraising crypto startups, or you can use other social media platforms for the marketing side?
I think specific to crypto startups, having Twitter presence is definitely very essential. Mostly it's Discord and Twitter. Everything else, I believe, is supplementary. Twitter, because the crypto crowd generally gathers on Twitter, and then the influencers that you want to help build your case for a raise, they already exist on Twitter. So a lot less education is needed versus if you were to target the ones on TikTok and Instagram, where the types of influencer profiles are very different. And then for Discord, it's primarily for a venue. So typically, I think it's somewhat of a funnel. People would read about your project getting mentioned on Twitter, a Twitter thread, because I think there are some DGen scouts. They would maybe put together a list of projects, like say 10 new coins to look out for, 10 protocols or 10 projects to anticipate in the next summer, something like that. And then once a reader looks into the thread and see the profile of the project that's mentioned, they would probably want to join the Discord server just to get to know the community better. So the community management is also quite important on Discord. You don't really want to have a community where everyone only talks about price every day. So that is usually a very negative sign on the community management. You want people to talk about something intellectual, even though it might not necessarily be related to crypto. It can be just philosophical arguments between the different individuals, and that is usually the kind of vibe that I think when a community member visits, they feel more welcome for some reason.
Awesome. Kevin, any thoughts on Twitter presence for founders?
I mean, it's important whether it's Twitter or now Thread. I don't know, the threat of people leaving X for Threads or wherever the case may be. Having some online presence is valuable. I think not only from the investment standpoint, but just from an influence standpoint for your user base. This is particularly important in crypto. I think in a lot of other industries, it's not so critical. You know, at the end of the day, the product is really the most important thing from a user growth perspective. And no amount of fame can help you get users for a shitty product. So, but from an investment standpoint, it was certainly important. I think it may be decreasingly important from a fund, just purely from a fundraise perspective. As investors, they're not going to ask you like, "How's your Twitter?" Right? How engaged? How much do you tweet? What do you tweet about? They might look for bad things on your tweet, on your X feed, whatever they call it now. So you have to be careful too there, right? People are highly opinionated these days on everything. But certainly on the raising from the token side, just getting users interested. Yes, of course, social media is important to build that audience, build the community. But from a traditional VC side anyway, not so. I don't think it's important. It doesn't hurt. Again, it can hurt if you say silly things. Sadly. Right. Even though freedom of speech is theoretically always present. Yeah, it's good to do. Don't let it distract you as a founder. I've seen lots of founders spend more time in a day thinking about growing their popularity on Twitter than working on their product. This is not an uncommon thing, sadly. It doesn't help you build better product unless you use Twitter or whatever else as a user feedback tool. Which I wouldn't recommend necessarily. Yeah.
Awesome. All right. Well, I think that concludes the Q&A and the Zoom portion of today's session. Once again, thank you so much to both Kevin Lin and TN for making time to share with kind of the future crypto builders your experiences and all these actionable advice and insights. Very, very much appreciated you guys being here.